So we'll continue our discussion on microeconomics, and in this reading, we'll go through the concepts of demand and supply analysis relating to the firm and how it relates to the profitability and the production of an individual company or a firm. So, the first concept that we will study in this regard is that of accounting profit. So, accounting profit is the profit that we have been studying hitherto in our school, or this is the profit that we talk about in the conventional sense, that is the revenue minus the costs. More specifically, in economics, accounting profit will be the total revenue minus the total accounting costs or the total explicit costs. Given the following financial information for the most recent accounting period, calculate the accounting profit for Seahorse Company. So total revenue is given to be $520,000. The cost of fiberglass is $125,000. Electricity costs $22,000. Employee interest expenses are given. So the accounting profit is the total revenue, that is $520,000, minus the total accounting costs or the explicit costs. How explicit is different from implicit, we'll study in the coming slides. So total explicit costs we can see is 125 plus 22 plus 60 plus 8. This difference will give us the accounting profit. So please verify. The accounting profit will come out to be $305,000, and this is the profit that we've studied hitherto, or the conventional profit as such. The definition of profit that we will use in economics is referred to as economic profit. So in the review on microeconomics, whenever we use the term profit, please note that it is not accounting profit. The profit that we will refer to in this session and in the entire discussion on microeconomics is actually economic profit. So, economic profit is calculated as the accounting profit minus the implicit opportunity cost. Or in other words, it is the total revenue minus the total economic costs, that is the explicit costs, which we referred to in the previous question, plus the implicit opportunity costs. Now, the opportunity costs refer to the benefits foregone, or the profit that could have otherwise been earned. We'll study that with the help of an example. So, continuing the example of Seahorse Company, assume that Seahorse took a pay reduction of $35,000 per year to start the company, or we can say that the founder of Seahorse took a pay reduction of $35,000 per year to start the company. He also invested into the business and could have earned $75,000 per year if he had invested the funds elsewhere. So what is the economic profit for Seahorse Company? We calculated the accounting profit in the previous question. The total revenue was 520. The total costs were 215, and the accounting profit was $305,000. So we had the revenue, we had the explicit costs, and we now need to see the implicit opportunity costs. So when he started the business, he earned a revenue of $520,000, and the direct expenses or the explicit expenses that he had to pay upfront for the various raw materials, interest expense on the debt, etc., was $215,000. However, it is also noteworthy that the founder paid himself a salary lower to the extent of $35,000 because he had just started the company, so he didn't want to probably overburden the company. So what we can say is that the founder paid himself below his fair salary to the extent of $35,000 per year. And he also had to invest his equity into the company and some money into the company to start the business. That money or those funds could have otherwise earned $75,000 per year had he invested them elsewhere. So the total implicit opportunity costs, or we can say the total benefit foregone, is how much? $35,000 because of this pay cut, and another $75,000 because of the funds that are now not generating this 75,000, they are invested into the business. So the implicit opportunity costs are to the tune of $110,000. Or we can say, even though Seahorse company is earning an accounting profit of $305,000, the economic profit will be 520 minus 215 plus 110. This is the total economic costs, or it will be 305 minus 110, that is equal to 200 rather $195,000. So please verify. The economic profit is $195,000. What this means is that yes, the company actually is generating an excess profit, because even though he took a pay reduction, even though his funds are not earning the $75,000, the money that his firm is generating is good enough to take care of all those missed opportunities or all those benefits foregone. So strictly speaking, if economic profit is equal to 0, it doesn't mean that the accounting profit is 0. It just means that the accounting profit is barely enough to cover the implicit opportunity costs, or the accounting profit is nothing super normal, or what the entrepreneur is making is what he could have otherwise also earned with his skill and his funds. So we'll study in the coming slides the accounting profit that makes the economic profit equal to 0. That is, the accounting profit that is exactly equal to the implicit opportunity costs is referred to as normal profit or normal accounting profit. So remember, if profit in economics is equal to 0, it doesn't mean that the company is making no money. It just means that the company is making a normal profit. It's not making any economic profit, or it is not making any super normal profit. Let's do one more example and understand. Long Lived Limited, a publicly traded company, reported $600,000 of revenue, $510,000 in expenses, and $450,000 in equity capital for the most recent accounting period. The required rate of return on Long Lived's equity is 20%. Calculate Long Lived's economic profit. Once again, economic profit is equal to the total revenue. Please note there is no implicit and explicit revenue. Revenue is the revenue that you have earned in dollars. So it will be $600,000, that is the total revenue, minus the total explicit plus implicit costs. The explicit costs are given to be $510,000. The implicit costs we need to calculate. So if Long Lived had not invested the $450,000 in equity capital, then the equity capital in any other similar risk investment could have earned him $90,000, that is 20% into $450,000. So the $450,000 that have been invested in this company are losing out how much? They're losing out on 90,000. That is $90,000 this 450 would have anyways earned. Even if you didn't invest it in the Long Lived. Even if you invest in any other company, you would be expecting a return of $90,000, or the funds could have generated $90,000. So the economic profit in this case will be 600 minus 600, that is $0. Or in other words, the firm is making an accounting profit equal to $90,000. That is 600 minus 510. But this accounting profit is barely enough to cover the implicit opportunity costs, or is barely enough to meet what the capital could have earned otherwise also. So this accounting profit, which barely meets the implicit opportunity costs, is called the normal profit. So the accounting profit in this case is 0, or we can say the accounting profit just covered the cost of equity capital, or what this $450,000 could have earned us elsewhere also. So the definition of normal profit should now be quite easy to understand. It is the accounting profit that makes the economic profit equal to 0. Or the normal profit is equal to the implicit opportunity costs. Another concept that is sometimes talked about is the economic rent of a commodity. So the economic rent of a commodity is defined as the payment to a commodity or to a factor of production above its opportunity cost, or above its next highest value. Or in other words, the economic rent is the excess price that you pay, which still does not increase the supply of the commodity. So economic rent is the payment over and above its next highest valued use, or its opportunity cost. In other words, this is the extra price that we'll pay, which still does not increase the supply of the commodity. So generally speaking, in the case of perfectly inelastic supply, for example, a piece of land in New York or anywhere, no matter how much price you pay for the land, will the supply of that land increase? Because that piece of land is fixed. In Manhattan, for instance. So for perfectly inelastic supply, even with a $0 price for the land, the supply of that land is fixed. So whatever price that you are paying is all the economic rent. That is, this is the excess price. No matter how much of it you pay, the supply of the commodity will not increase. For perfectly elastic, there are many such examples. If you have a gold mine, then you can earn a lot of economic rent, because you can mine only as much, and if the price of gold goes up, then whatever additional is the economic rent that you are earning. So this will be the excess price that you as a shareholder of that gold mine can enjoy, or the economic rent that you can enjoy. For perfectly elastic supply, there is no economic rent, because the price is equal to the opportunity cost, or as the price increases, the supply of the commodity also increases. As the price decreases, the supply of the commodity also decreases. The supply is perfectly elastic. So remember, economic rent is the excess price which will still does not increase the supply of the commodity. That's the economic rent, or the payment to a factor of production above its next highest valued use. Now, interesting concepts are that of the total revenue, the average revenue, and the marginal revenue from the production and sale of a commodity. So, given the demand curve for a firm's product below, calculate the total revenue, the average revenue, and the marginal revenue for the first through the 7th unit, and draw the marginal revenue curve over this range. Now remember, total revenue is simple as the name suggests. It is the quantity multiplied by the price of production. So for 1 unit it is $80. For 2 units it will be 70 into 2, 140, 180, 200, 200, 180, 140. This will be the total revenue from the production given the following prices. So if I produce one shirt, for instance, I can sell it for $80. For 2 shirts, I can sell them for $70. If I sell 3, I'll have to cut the price down to $60, so on and so forth. For selling 7 products, the price has to be brought down to $20 per shirt. Average revenue is defined as the total revenue upon the total quantity. So in this case, it will be 80 upon 1, the total revenue upon the total quantity. 200 upon 4, 200 upon 5, 180 upon 6, 140 upon 7 is the average revenue. We will see in this case it is coming out to be similar to the price. So this is the second definition, that is the average revenue. A very interesting concept is that of the marginal revenue. So this is the incremental total revenue, or just the incremental revenue from the sale of one additional product. So let's see. For selling one product, the marginal revenue was $80, because if you sell nothing, you will get nothing. So if you sell one product, your marginal revenue is 80. If you sell 2 products, then what is the incremental revenue from the sale of one additional product? Please note it's not 70. It's 140 minus 80, that is $60. Then again, for the sale of one additional product from second to the third, the additional incremental revenue is $40. For the sale of one more product, the incremental revenue, even though you're selling the fourth product for $50, the incremental revenue that you're gaining is only $20. If you sell 5 shirts, then we realize that the marginal revenue is actually 0. There is nothing additional that you earned. Please note, why is this happening? Even though you're selling one additional shirt and you're gaining $40, so you're gaining $40 on the 5th shirt, you're having to cut the price of the previous 4 shirts also by $10. So you're gaining $40 on the 5th shirt, but you're losing $40 because you're selling the 4 previous shirts which you were selling for $50 now $10 lower. So $40 lost on 4 shirts on which you have to cut the price, because if you're selling 5 shirts, then the price that the market will absorb is $40. So producing and selling the 5th shirt actually didn't give us any additional revenue. We would have probably had to incur a cost of making this 5th shirt, but we still didn't gain anything additional in revenue. If we make 6 shirts, there will be an oversupply and the price will come down to $30, and the revenue will actually come down by $20. The marginal revenue will be lower to the extent of $20. Similarly, for the 7th shirt, the marginal revenue will be minus 40, or the revenue will come down by another $40 if we produce and sell that shirt. The reason this is happening is that as we sell more, we not only cut the price for that incremental, but we have to take a price reduction for all shirts, because all shirts are the same. It's the same commodity. So it will have the same price, and if you produce more and more, you will dampen the price, which will cause an incremental loss. So the price, the total revenue as we calculated, the average revenue, which is the same as the price table, and the marginal revenue for the first 80, and the marginal revenue kept on coming down. So it's a very important derivation that we have done, which depicts that the marginal revenue falls faster than the average revenue. So as the quantity of production increases, the marginal, or rather the average revenue, will come down because you have to cut the price. This is the average revenue line. This is also called the demand curve. The average revenue curve is also the demand curve. It is at a particular price how much quantity is demanded. At a particular price how much quantity is demanded. The average revenue curve is also the demand curve. Please remember, we'll need all these concepts in some very complicated derivations that we're going to do going ahead. So please understand this very well. The average revenue curve is the same as the demand curve, and we proved earlier the demand curve is also known as the marginal benefit curve. The marginal revenue is a steeper falling curve as compared to the average revenue curve. So as the quantity of production increases, the marginal revenue will start with 80, but it will fall more sharply as compared to the average revenue. So as quantity increases, the fall in the marginal revenue is much sharper as compared to the average revenue. And that's because as you increase the quantity, you take a price cut not just for the incremental quantity, but also for your existing base, which reduces your marginal revenue. We even saw the marginal revenue can become negative after a point in time. So that's the concept of the total revenue, the average revenue, and the marginal revenue. For any process or for any kind of production, generally speaking, we require four inputs. We require land. This is the actual land on which we will build our factory. There is labor, that is the people working in the factory. There is capital needed. This is the machinery and equipment that we have installed in the factory. And finally, we will require materials, that is raw materials, some coal, limestone. Something has to go in for our product to come out. For the purpose of further discussion, we will club land, capital, and materials into one factor called capital. So capital for us henceforth means all of land, capital, and materials. And we will study the production as a function of the capital and the labor employed. You can imagine that if you want to increase production or you want to increase the quantity produced, you would have to increase all of these inputs. You'll need more land, more labor, more capital, more materials to be able to produce more and more of a particular commodity. In economics, we define short run as a time period in which at least one factor of production is fixed. So at least one of these four factors is fixed. In the long run, everything is variable. All four factors of production are variable. That is, you can increase the land also. In the long run, you can put up more capital, you can source more materials, you can hire more labor. But in the short run, you cannot immediately do that. Or at least one of the things. In the short run, you cannot just increase the land, or you cannot increase labor, or you cannot increase the machines, or you cannot immediately source more material. So remember, in short run, we define in economics as a time in which at least one factor of production is fixed. Now, the next concept will be the short run production function. We'll understand this with an example. So let's assume that there is a factory and the factory has two machines. There is a one machine that makes the yarn and a second machine that makes the garment. and we hire one labor at the moment who works and produces shirts. The one labor, through his hard work in the day, is able to make 6 shirts. This is the quantity of labor, and this is the output, you can say, or the number of shirts they make. So the one labor is probably working half the day on making yarn and half the day on making the garment, and in the whole day he's able to make 6 garments. Now please try to think that if you added one more labor to the production process, so if there were 2 labor, then what would be the output? Would it be 12 or 10 or 14? Please think for a while as to what you think the output will be if we added one more labor. We still have 2 machines. Amongst the 3 options, that is 12, 10 and 14, we'll just discuss that the most likely option is that the 2 laborers together will be able to produce 14 shirts, and we are assuming there is infinite supply of raw material, or rather there is adequate supply of raw materials. One person individually was able to make 6 shirts. That is, in half of the day he was able to make the yarn for the 6 shirts, and in the remaining half he was making the 6 garments. Now if we have 2 laborers individually working on the machine, by the sheer fact that they have twice the amount of time available, each individual person can now do 6 into 2, 12 shirts worth of yarn, and similarly on the second machine the second laborer can do 6 into 2, 12 garments, because when they were working half the time, or when one person was working half the time on each machine, he was able to do so for 6 shirts. If both of them are working together, they will be able to do it for 12 shirts just by the sheer extra time that they have. However, we've noticed that when one person is repeatedly at a task, he gains some skill and some expertise in doing that job. So initially this one laborer was a master of none. Neither was he a master of producing yarn nor a master of producing garments. He was working half the time at one machine and half the time at the other. Now that the first laborer is specializing in the yarn machine, do we all understand that his productivity would be better than earlier because he is now a specialist at making yarn? So amongst the given options, we can conclude that if earlier, or with the earlier skill, he was able to make 12 shirts with the time he had, now with the specialized skill in producing yarn, because he's dedicatedly doing that job, he would be able to make 14 shirts. Similarly, the second laborer is an expert at making garments. If an unskilled laborer just by the sheer time would have been able to make 12 shirts, and the skilled second laborer who's focused and dedicated on making garments would be able to make 14 garments or 14 shirts. So we see that there are increasing returns to labor, or the marginal product of labor is now 8 units, or the incremental output from hiring one more labor is 8 units. This is also called the marginal product of labor. That is the increase in output by adding one more labor. However, when we add the third labor and we ask the same question, that will the output now be 20 or 22 or 18? So if we add one more labor in this factory, then what will be the output? Will it be 20? Will it be 22 or will it be 18? In such a scenario, our best guess now would be 18. The reason being, capital is fixed, or the amount of machinery and equipment is fixed. If we have to increase the quantity of production, we need an increase in all factors of production. Just by increasing one factor of production, we can't infinitely increase our quantity produced. This third labor doesn't have a machine to work on. So definitely adding the second labor was a very productive activity because there was specialization happening. So the marginal product was very high. But with the third laborer, there's not enough machines, there's not enough capital for him to work on. So he'll probably be sharing these two machines and trying to make his garments or his shirts. So his productivity is not as high as the second laborer. So the marginal product of the third laborer is only 4 units or 4 additional shirts. Similarly, if I add a fourth laborer, he'll probably give me even lesser. He'll probably give only about 2 additional shirts because there's no space for him to work. With the fifth labor, we find that the productivity doesn't increase at all. So the fifth labor really can't do anything in this factory because there is no machine. If we continue to add more and more labor, we can find that not only will we be incurring extra cost on this labor, but in fact the total product can even reduce, because the sixth guy comes into the factory, he doesn't have anything to do because he doesn't have any space to work. Neither is he working himself, nor is he working the others, or nor is he letting the other people work, the 3 or 4 who were actually working. So we see the product or the total product actually decline because of the disturbance caused by the sixth labor. So that is also possible. So remember, initially the marginal product of labor is very high. That is, the output increased by one additional labor is very high, but that keeps falling if capital is fixed in the short run, and the incremental marginal product of labor will be low. Not to say that this fifth or the sixth guy is not as skilled or he is a particularly bad worker. It's just that there is no machine available. There is no capital. In the short run, we have fixed at least one factor of production. In our example, we fixed the capital, the machinery and the equipment. The next graph basically depicts this phenomena. So originally, the marginal product of labor is positive. That is incremental labor. This is when we add the second labor. The second labor is very productive. We had only about 6 units. With 2 people, we had 14 units. There was an 8 units marginal product. So to a point, marginal product will be increasing. A to B is from the second to the fourth labor, wherein we saw the marginal product is still increasing. This 14 became 18, the 18 became 20. So 2 units improvement was happening on the total output. But the marginal product is decreasing. The third person was only able to add 4 units. The first person added 8. And the fourth person was only able to add 2 units. And after that, we saw that the marginal product can even become negative. From the sixth person onwards, we'll saw that the output declined to 19. This was our example of capital, fixed and variable labor, the relationship between the total output and the quantity of labor. Remember, initially there is specialization of labor happening. We have enough machines, so we have enough capital. So adding labor really helps. But after a point, adding more and more labor won't help because capital is fixed. So the marginal product will start to decrease. Beyond a particular point, it may also become negative.